Welcome, everybody. Welcome to the weekend report for March 17th, 2023. As expected, CPI report came in. Numbers were where we kind of expected, but again, not a big market mover, mostly in part because shelter in place still continues to affect this report. The data information from shelter in place, which deals with rents and people that are staying at motels and hotels and so forth, it's a lagging data, especially for those in terms of the rent, housing for college students and rent, because those leases that people sign are for a year. So seeing the current market and the fact that rents have come down, we're not seeing the impact in the shelter in place numbers in the CPI report. So we don't expect those numbers to really catch up with the current market until May. That's where we see the potential for the largest change in the CPI reports, which will be a good market mover. Now, the PPI report came out this week, and that's a measure of wholesale inflation. And again, this was for February. The headline number was down 0.1%, and the expectation that it was to be up 0.3%. So that was kind of a surprise for some people. Year over year, there was really good movement. The numbers went from 5.7 to 4.6%. But the core rating was flat, unchanged month over month. But year to date, still seeing some really good progress from 5.4 to 4.4. But this doesn't seem to be influencing the Fed in any way. Still talks about raising interest rates coming up for the next Fed meeting. We'll see. Retail sales for the month of March were down 0.4%. Not much of a surprise there, because I think that's just how things are going to trend with the cost of goods continuing to go up. Biggest news this week, of course, was Silicon Valley Bank. Last week on a Friday was shut down. They are filing for bankruptcy, but the feds did step in, and rather than bailing them out themselves, they forced 11 of the largest banks to deposit $30 billion in their bank into Silicon Valley Bank for a minimum of 120 days. A very band-aid fix for this. We really don't know what's going to come of this after that 120 days, but right now there's definitely unrest in the markets as it relates to banks and people concerned about whether their money is safe or not. The last thing we need is a run on banks, but if the Feds go into their meetings next week and continue to be aggressive with Fed rate hikes, the rate hikes, this does not bode well for banks, because they're just not making the difference in margins that they need to be to show the asset liquidity that they need to have. So it's definitely putting a strain on the banks now. Housing starts came out for the month of February, showed that for single family homes, they were down 32% for starts. And then permits were down 36%. Now, the number was a little bit misleading because the overall number looked pretty good. But that was because there's more building going on with multi-family homes. So the single family homes are taking a hit as opposed to the multi-family homes. So again, next week is going to be big with the Fed meetings. We'll have to see how they talk about these short-term interest rates, whether they're going to hike again up to 50 basis points. We'll see. Certainly, again, detrimental to the banks. But let's take a look at the markets and what we've been experiencing through the week. You can see right now that we are up 44 basis points for the day. That does bode well for us. But over the last week, we've seen the day start off really well and then lose a lot of our gains. So we're just kind of all over the place. We're making a little bit of ground, but not a lot of traction at this point. So that is where we are. If you have any questions, please do reach out to me. I appreciate your comments or questions. And I do appreciate when you like and share my videos. Have a great day, and I'll see you next week.